Excellent. So, ladies and gentlemen, it's a pleasure for me to give a presentation on the state of the market for juniors and developers. I'm Managing Director of PCF Capital, also Managing Director of Mines Online and Future Gold. Here's our standard disclaimer. In terms of who is PCF, we've been in business 20 years, celebrated 20 years very recently, and we're probably best known for our project divestment business. We're the number one broker or dealer in mines in Australia, having dealt more projects than anyone else. And then we also have a business, Mines Online, where we do smaller deals, a bit like an eBay for mining projects. We've got about 4,500 users around the world, and it's very effective for getting a value on a project. And when you've got a market which is so tough for juniors, where you can't raise equity, sometimes dealing your project and getting cash or shares through a forum like Mines Online is worthwhile, and it's been a very effective mechanism. More recently, to try and bring some capital into the mining sector, we formed Future Gold. That's a streaming business. We're looking to raise 100 million. We've raised the first 25 million and are currently looking for some streaming opportunities. I'll talk a little bit about streaming in this presentation and give you an example. It's certainly not as popular in Australia as it is in North America. But when the cost of equity is almost infinite, it's certainly something that you should be looking to consider when you're trying to fund yourselves. And more recently, we signed a joint venture with Zhaojin, the Golden Gateway joint venture. The logo there is two hands holding up a bridge. One's China, the other one's Australia, and the bridge representing a conduit or a pathway for capital from China into Australia. Our obligation is first to show projects to, if we decide, we don't have to show them anything, but if we do show a gold project, we must first show it to Zhaojin. They are China's fourth largest gold producer, produce 700,000 ounces per annum, and have a stated strategy of matching that production internationally. And while I was up in China, there is a real push to counter this trade war, and there's a push by the Chinese government to expand their businesses and to be less reliant on the United States, and they love Australia. So any deal they can do in Australia, they're very encouraged to do so. They certainly recognise that they haven't been that successful. During the mining boom, they probably spent 52 billion of Chinese outbound investment came into Australia, and they torched most of it. So I think they've learnt from that, and hence the formation of a joint venture. They're looking to do joint deals. They'll take equity, they'll fund debt, and certainly look at buy projects 100%. But I think it's a great conduit, and we're very keen. We're showing them a few deals at the moment, and if we get those away, hopefully there'll be a pathway to other companies and other transactions. Key themes for juniors, and we've heard this throughout this morning. The world wants a self-funding model. Investors want low capital intensity, fast payback, and cash-producing assets in safe jurisdictions. They want 30% IRRs and 3-year paybacks. And a lot of the projects that I actually presented this morning had plus 30% IRRs and well under 3-year paybacks. And there's also got to be some relativity between your market cap and the amount of capital that you're looking to raise. So you need to sort of tick those boxes if you want to get register any interest with a lot of the equity houses. Junior miners and explorers across the globe are certainly suffering from a capital strike. Minimal investor interest in grassroots exploration or single asset companies. So I know we looked at, Barry had a slide this morning that showed exploration sort of on the rise, but most of that exploration money has been spent on brownfield targets. So existing mines or old mines, there's very few grassroots deals. And those that we are seeing grassroots deals are generally funded by a Northern Star or St. Barbara. So there's a big brother strategy. And you can tell the lack of interest in risk appetite with the lack of IPOs. And hopefully we'll see that turn around. Also, we've got these index-hugging ETFs, and they're conquering the universe. They are the preferred investment vehicle for many mining investors, and they're diverting investment out of gold stocks and into the ETFs. So they're sucking volume and value out of the mining sector into their ETF structures. So there's a one-time sugar hit when they come in and buy 6 or 10% of your stock, share price goes up, and then they issue shares, they trade shares on their own exchange. And the GDXJ is the junior one, that's 4 billion worth of value, and the GDX is 12 billion. And the turnover and liquidity is insane. So they're the preferred vehicle to trade. But while they're trading in those, they're not getting behind any of the mining stocks. And the flip will come when people want to exit some of these ETFs and you've got no liquidity or less liquidity in the underlying mining stocks. There'll be a bloodbath, and then wealth transfer away from those that invested in the ETFs back to hopefully the managed funds. So conferences like this, exploration success that we've seen over the last couple of months, I'm hopeful will rekindle investor interest in the junior sector, will rekindle interest in managed funds, where someone is looking at the value of a proposition rather than working on an algorithm, because that will end in tears. The merger and acquisition path, it certainly provides a pathway to upscale and get on the radar of some bigger funds and the ETFs, and we expect increasing activity in the year ahead. And one of the key deals earlier on this year was the Darwin Silver Lake merger. Darwin had a market cap of 150, Silver Lake market cap of 300 mil, both good companies, came together, it was a $450 million combination. But we knew when they came together, they'd get onto the ASX 300. And literally within 3 months, that market cap went to 1.2 billion. It's incredible. That's why, again, this morning I was saying, if you've got a market cap north of 500 mil, it's sunshine, you can get all the attention and you get the attention of the funds. If it's south of 500 mil, it's really hard. And there are opportunities there, but the 500 mil being that bar is a pretty big bar to try and reach. But if you can get it, you'll get on the radar and there is a value uplift. There's a quote from Charles Darwin to think about, and it's to encourage the juniors. It's not the strongest of the species that survives nor the most intelligent, but the ones most responsive to change. And that's how you survive. So you don't have to be the toughest or the biggest, you've just got to be the most responsive. And I loved Andrew Wascott's presentation looking at what Minotaur had done and the deal that they'd cut with Oz Minerals. I think that's what you need to do. You need to keep looking to reinvent yourself and push the boundaries. In terms of market appetite for risk, there's a table here which shows mining and resource IPOs on the ASX and the TSX. The ASX in the blue, TSX on the bottom, and it just shows, the ultimate barometer for the appetite for risk is an exploration IPO, and most of the IPOs in the mining space are generally exploration plays. Now, on the ASX for 2016, 17, and 18, you can see on the far sort of left, you can see that picked up, and we've shown signs of life, and 2018 was a pretty good year, but it's died, fallen into a big hole in 2019. And it's even worse in Canada. I mean, we've still got a pulse, but the Canadian market's almost dead. And they've had the added impact of the cannabis boom. There's been billions raised for cannabis, and the sort of investors that you'd expect to get in behind a junior mining stock have got behind the cannabis trade, and they've made billions and billions of dollars. But that's coming off, and I've got a chart on that in a second. But I don't know whether it's going to change. Barry said this morning that hopefully we'll see a flood of IPOs come back. I'm not so sure. I'm not so sure that the market's ready for junior companies and a flood of junior companies. Anyway, we'll see. I'd love to see it, but I'm not convinced. In terms of grassroots exploration, there's a chart here. These are drilling results, and the bottom two colours of those bar charts being, the orange and the reddish colour, just show the drilling results around brownfield targets. So most of the announcements that have come out over the last sort of 10 years in particular have been around brownfields rather than grassroots. And there's a steady amount for grassroots, but I think a lot of that's been funded by the big brothers. And certainly over the last year or two, anyone funding, raising money for exploration, it's almost being, a lot of the funds have said to me, it's like writing money off. You may as well write it off straight away because so many of them come through. And we need to turn that around, and with the Staveley results and Anglo-Australian results and Alkane results, maybe that will show that there is still a lot of deposits to be found. Is bigger better? We saw last year the Barrick and Randgold merger of equals is a nil premium deal. And if you listen to Mark Bristow, and he's saying, well, we had to come together because we wanted to become more relevant to the investors and to be the number one investor choice. But if you've got Barrick and Randgold coming together to become more relevant, what does that mean for everybody else? That's my takeaway point there. And that's worked really well for them. When they came together, they had a 24 billion merger value. At the moment, it's about 32. So it's been a great success for Mark Bristow and Randgold. Looking more recently, we've seen Cisco come together or put a bid in for Barkerville Gold, and that's at a 44% premium. I think you will see premiums where you've got a producer taking over a developer. That makes sense. But when you've got two of a kind, or say Northern Star taking over Echo, where you've got a producer and a developer, there's a value arbitrage and you can understand the reason for the premium. But when you've got like for like, maybe a Newmont and Goldcorp, Barrick, Randgold, Silver Lake, Doré, you can understand why let's go for a nil premium. There have been a lot of surveys over the years that have shown that corporate takeovers, with a big premium generally destroy shareholder value. So why don't you come together at nil premium and let the market decide whether or not it's a good deal. And I think we'll see more of them, but I think size matters and bigger is better. The streams versus equity, they're very popular in North America. You mention a stream here in Australia, you generally get shot, but what is a stream? It's a purchase agreement for a future portion of metal produced at a mine. And is it a better alternative to equity? We've identified there's about 300 companies around the world with a 1 million ounce resource and a 30 mil US market cap. So they're valued at $30 an ounce. And the cost of equity for many of those is almost infinite. For them to try and raise 5 million US, they might have to dilute themselves by 15 to 20%. And if you're raising equity and making a placement, diluting yourself to 20%, I mean, that's 20% of every single asset in the company. Alternatively, you could look at a stream. And if you've got a 1 million ounce resource, maybe you could sell 50,000 ounces of that for maybe $100 an ounce up front and a $200 an ounce on production. So you're valued in the market at $30 an ounce, but you can get a stream away at $100 an ounce. And they're the sorts of deals we're looking at Future Gold. Every deal is different. Future Gold and a lot of these streams are driven by IRRs. But if you do a stream, certainly with Future Gold, you don't have to pay it back until you get into production. And it's also got to be subordinated to the bank finance as well. So the other issue with a stream, quite often it's a secured structure. So if you've got a security in place before you get your bank finance, you can get into a bit of difficulty there trying to get your debt. But as long as, I guess, the streamer recognises that he needs to get you, or the streamer needs to get you into production, therefore they've got to take a second ranking position when the bank finance comes in. But I think it's a very good mechanism. So there's an initial payment up front, order of magnitude $100 an ounce, could be $150 an ounce, and then when you actually produce an ounce, you get a second payment. So the total might be $300, $400, $500 an ounce. A big discount to the current price of gold at $1,500. But it's still less dilutionary and less expensive in some cases than raising equity. So I think you're going to see a lot more of them, and I think they will become more popular. As I said, they've been popular in North America, South America, and Africa, but generally they've been frowned upon in Australia. But it's just, if the equity market, if you can raise equity, go for it. If you can't, this is a mechanism where a group of finance is coming in and saying, we want to move up the capital structure. We don't want to take shares. We don't want to be the last one to get paid. We actually, as soon as you start making cash flow, we want to be on the horizon and certainly getting paid. So I think they're good ideas. It doesn't suit everybody, but I think it's one of those things that should be in your arsenal, especially if you're moving towards development. ETFs, and I've had a bit of a crack at these guys. It's a 20 billion, probably more like a 30 billion US business. They offer all the benefits, exchange-traded funds of a traditional fund, but trade on the open market, adding the liquidity advantages of a stock, and have very low management expense ratio. Some of the big ETFs that track the main indices in the United States, their management expense ratio is 0.02%. So it's like $2 for every 10 grand. I think the GDXJ, it's a management expense ratio of 0.52. So it's $52 per 10,000. So it's still a lot cheaper than, say, your traditional fund manager that might be charging you 2% and then have a performance fee. So the fund managers, the active fund managers, have almost been wiped out by this new ETF model. But and now, as I said this morning, there used to be 30 big funds that you'd go and talk to in Canada. If you're trying to raise money, you'd go see 30, and hopefully, a couple of them would write you a check. Now there's only 5 left, and all the money's gone into these ETFs, and they won't. You can't get a capital raise from an ETF. They won't underwrite a placement. Where do they stand on a takeover bid? You can't sort of say, I'm under takeover threat, line up your major shareholders. If you've got an ETF there, you're talking to an algorithm. So I'm not sure what real value they bring other than pushing up your share price when they come in after the event. I think they're possibly a net flow. And turnover on the VanEck Juniors ETF is 90% versus the weighted average weekly turnover of the same ETFs in constituent stocks is about 6%. That's per week. So I think might be a Northern Star or an Evolution might be on there. Reasonable liquidity, but nothing like what you get with the ETFs that hold them. So you can see their attraction, but in the end, I suspect when there's a head for the exits, when people realise that a lot of these stocks might be overvalued, I'm not suggesting any of them are, but some of them are trading at NAVs between 1.5 and 2 times, which would suggest they're expensive. When there is a move for the exits, there may well be mayhem, and that'll move back to to traditional funds management. Has the popcon boom bubble burst? Well, you can see it's down 45% from the peak, and that's been had a massive impact in Canada, in North America. A lot of the mining companies move very quickly, as they want to do, into the cannabis space and have made a fortune. And some of the biggest companies on the Canadian Stock Exchange are still cannabis stocks. And the return of the top 10 over the last 3 years on average was 2,000%. So it's been insane. I mean, you'd be mad not to have got behind it. So you can see why the mining sector has been left behind. But I think value is returning, and hopefully some of the money that made money out of cannabis will put it back into the mining space. The Bitcoins, they're coming back into fashion. When you've got global interest rates heading down to zero or negative, I mean, there's no justification to put money in the bank. I mean, the whole banking model falls down when you don't pay people money for putting, you don't pay them interest for putting money on deposit, or you actually penalise them. I mean, if you buy, a 30-year Swiss bond, you're guaranteed to lose money. And, the banking system is sort of breaking down. Hence, some of these coins, stable coins, are picking up in value. Facebook have the Libra coin, and The Economist magazine said if people put 10% of their money into the Facebook Libra coin, and that's 10% of their cash deposits around the world, all the banks in the world would have a massive liquidity event. They wouldn't be able to cope with the repatriations to pay that 10%. So, the banking sector is not, I don't think it's out of the woods. I think once you get negative interest rates, their business model comes under threat. But what we have seen, so whilst I still see a role possibly for a Bitcoin, there has been a reduction in these new crypto offerings. You can see on that chart there that it got up to 650 ICOs, initial coin offerings in 2018 with 17 billion US raised, and it's down to just around 3 billion so far this year. And the issue with these ICOs is that they thought that they could provide a mechanism to raise capital that would get money from the retail sector, using the blockchain. But as soon as you touch a retail dollar, you'll have the SEC coming in. They've been a bit slow out at the gate, but a lot of these guys are now being checked out by the SEC. And if you raise money in US dollars, they'll hunt you down. And so I'm not sure that there is a mechanism where you can use an ICO and the blockchain and touch retail. But I think there might be a mechanism for the accredited investors. So crypto solutions for sourcing capital, it hasn't really worked. They've been targeting broader retail networks initially, but none of them have delivered a funding solution. Legal compliance is killing them. And the disappointing truth is that although the blockchain is great technology for serving retail investors, from a legal and regulatory point of view, they're very hard to target, the retail guys. So they walk on uncharted grounds in many respects, but the fog is lifting and many guys are getting caught. So I don't think the crypto coin is going to come up with a mechanism that will solve our problems necessarily. But what change is happening is the rise of private companies. So we tend to focus on the listed markets, the ASX, the TSX. There are 450 million private companies around the world versus 85,000 listed companies. Last year was the first year ever more money was raised for private companies than there was for public companies. Now that's never happened before. And while I was we were in Wall Street trying to raise money for Future Gold, we were talking to these guys that promote these digital securities. And there are alternative trading systems. There's a group called Core Connects that used to be, or still is, a security transfer agent. They have 65,000 companies on their register. And they've come up with a blockchain initiative, an alternative trading system that's compliant with the SEC, is compliant in 8 jurisdictions around the globe, and it's a bit like an internet banking site. And now they've got broker-dealers coming on. So if you want to get onto their network, you go through a Canaccord or a Macquarie Bank, they do the compliance, the know your client, anti-money laundering, and you come onto this network and you can trade your private shares. And it's an incredible development. And these are popping up everywhere. The technology is relatively straightforward. It settles via the blockchain, and it's a real threat to the stock exchange model. Trading shares is cost zero. The banks, so the broker-dealers make their money by pricing placements, but in terms of trading shares and getting in and out, it's for free. And there are 16 alternative trading systems launched in the US. There are 8 trying to take down NASDAQ at the moment, being a competitor. And there's a quote here: with the decline in the number of public companies and the rise of private financing, there's a need for efficient secondary market trading for private securities, and a blockchain-enabled and global compliant securities critical to the success of secondary markets for private securities. So the future is here. That's already happening. And there may well be a space where we see junior companies go, well, actually, do I need to be on the ASX? I mean, what's the point of having the same set of rules whether you're a $5 million market cap or 100 billion market cap? Why would you have the same set of rules? Is there a better market for them? And one of these ATSs may get up. And there's nothing to stop a junior gold company listing shares or issuing shares to accredited investors through one of these alternative trading systems. So I think it's very exciting. There's a slide here looking at the number of listed companies. This was on the New York Stock Exchange. 10 years ago, there were 7,500. Now there's only 3,500. Only half the number of companies that were listed. So it's happening around us. We're probably not necessarily seeing it on the ASX, but on the international markets, we're seeing a big drop-off. We're also seeing that IPOs, which are often the mechanism to realise value, actually it's not. It's more, most exits now are through a private M&A deal, and the private equity funds are sort of stepping in. So the chart down the bottom in the red, you can see the big increase in exits via a private equity merger and acquisition versus an IPO. So these things are happening around us, and so the IPO isn't necessarily the answer to everything, and these alternative trading systems, even when these companies buy a chunk and make it private, they might put it onto one of these alternative trading systems. Slide on digital securities. These are the collective name for electronically registered financial securities. For all intents and purposes, it's a share, but it's settled via the blockchain. And on that right-hand side, you've got access to a global group of broker-dealers. They do the anti-money laundering, know your client stuff. The registry that they use instantly updates, and we had a look at it. And we were looking at issuing digital securities for future gold, and we had a lot of interest about it. But when we were pitching it to the North Americans, as soon as you mentioned blockchain digital securities, the whole discussion went down a rabbit hole. So we had to swap quickly back to conventional shares and conventional securities. But I think digital securities have a big future, and the stock exchanges need to come up with a mechanism to capture them. I think they're a great thing. So to recap, so the world wants this self-funding model. I think we're all in agreement with that. ETFs and strategic placements with major producers are not necessarily the answer for junior funding. ETFs are more likely a foe than a friend, so I think I've made that clear. We need to come up with alternatives to funding rather than equity. Emerging forms of finance should be considered, and I think streams have a role to play, but you've got to have a resource and a pathway to production before I think that becomes available. Cryptos and ICOs have been targeting this broader retail network, and they're still out there, but none have really delivered a funding solution. A lot of them have the SEC on their tail. And I do think that there will be a role for digital securities and trading on one of these alternative trading systems. And I get that sense that it's a very big market, and there's some very large players that are moving into that space. And it might be, we see a transition where we move away from normal stock exchanges to one of these alternative markets. So there you have it. I've finished a little early. We've got the next session, which is a bit of a fireside chat. And I'll introduce the two gentlemen who are joining me in a moment. And Michael Mamet is going to talk a little bit about some M&A. But just before I invite them up onto the stage, are there any questions that anyone might have at the conclusion from my presentation? Barry. So is there a microphone coming around? Here comes one just now, Barry.
My apologies, Liam. I came in a bit late, but this is really fascinating, and it sort of reflects the frustrations I think everyone's having with ASX and in the mining sector, or certainly the small caps. But what does this mean for interest rates? If we've got all this money being raised and going into private businesses and money taken away from the big listed exchanges, what does it mean for interest rates? Is there some connection there that you see?
Oh, that's a great question, Barry. The whole world, to try and stop the world economies imploding, the world governments have lowered interest rates. They're probably 2-3% lower than where they might otherwise be. That's created a massive reallocation of resources into the housing sector and into the top end of the mining of the global stock market. So you've got a lot of these assets that are overpriced, and the mining sector I think has been a casualty of that. So and now we've got negative interest rates. Well, I think I agree with your comments this morning that we've had this bull run in bonds where the interest rates got lower and lower. Now it's turning. They've overshot, but they'll pick up the other way. and with a bit of luck, we'll have some inflation on the back of that, and commodities, fixed assets will be the business to be into, and mining stocks. So, look, I don't know, but we've had this manipulated interest rate environment for the last 10 years, with governments, depreciating their currencies and knocking down their interest rates. Well, every action has an equal and opposite, reaction, and you can't do it. And it's pushed money where it shouldn't have gone. And I don't know. I think ultimately they go up, Barry, but I'm not smart enough. Thank you.
It seems to be a really interesting conundrum for us. Thank you, Liam.
Pleasure.